I say this, yes, as the owner of a large gold company, but more as someone who's trying to be completely straight with the public. There is no better investment I've ever seen in 34 and a half years of finance than silver, period.
Yeah.
And gold is right there, but the leverage that you get and an asset that is still trading, almost half of its all-time peak from 1980 is something that has been skewed, its real value, skewed by the London Metals Exchange and the COMEX and the bullion bankers who suppress the price. Someday people will look back, like you said, and say, my God, why didn't I trust my gut on that? I don't know that I've ever seen a better value.
In May, silver prices surged past $30 per ounce for the first time in over a decade, fueled by expectations of a potential Federal Reserve interest rate cut and escalating global geopolitical tensions. This spike has enhanced silver's allure as a safe haven asset. Analysts suggest this resurgence could start a more sustained bullish trend, especially as we face a projected fourth consecutive year of structural deficits in 2024. The Silver Institute reports that silver demand outpaced supply for the third straight year in 2023, resulting in a deficit of 184.3 million ounces. While this shortfall was 30% less than the previous year's peak, it remains one of the largest on record, underscoring the persistent supply-demand imbalance. Industrial usage surged despite a 7% decline in total silver demand last year, particularly in green technologies such as photovoltaic solar cells. This sector saw unexpected capacity growth and advanced model adoption, driving industrial demand to an all-time high of over 654 million ounces, a remarkable 11% increase. Andy Schectman notes that industrial demand for silver is projected to potentially consume the entire market by 2025, driven not only by traditional applications, but also by significant military and emerging monetary uses. The Silver Institute's data indicates that this rising demand far exceeds supply, raising concerns about whether current market structures can support the anticipated consumption levels. Similarly, the gold market is witnessing a significant increase in physical demand as investors shift towards direct ownership rather than engaging in leveraged trading on major exchanges such as the LBMA and COMEX. In the second quarter of 2024 alone, over 330 tons of gold were withdrawn from the London market. This trend indicates a growing preference for tangible assets amidst concerns about market manipulation and opaque financial practices. The movement towards physical gold ownership leads to a depletion of available inventories, with actual trading volumes markedly exceeding official settlement figures. This underscores the vulnerability of the market structure, which relies heavily on extensive asset rehypothecation. Please tune in for our exploration of Andy Schectman's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
Industrial demand, what does that really mean? I mean, look at the Silver Institute numbers, and that takes out of the equation, as we've talked about before, military uses. And we know that they use a copious amount in military. That doesn't really even speak about monetary uses. And so, yeah, it's one of these deals. And I know, what we talk about on your channel is primarily silver, but I think it's important to also bring into the context gold because they are connected so closely. And, first of all, if we look at the same criteria, gold delivered on the August contract so far is almost 30% of the entire registered category, meaning the registered category are the bars that are available for delivery backing the contracts. 30% of it was delivered already, nearly, in just the August contract. And, that works out to 4,142 100-ounce contracts. So let's see how much money that is, right? 4,142 times 100, that's 414,200 ounces. Let's just call it times 2,500. That's 1,035,500,000, if I'm not mistaken. The point of it is that who the hell's got that kind of bread to stand for that kind of delivery? In quarter two of 2024, over 330 tons of gold, or 10.6 million ounces of gold, was delivered off the London over-the-counter market, or the LBMA. So when you talk about gold and silver, you can see the massive value that very sophisticated investors are seeing in not only accumulating huge amounts, but give me it, taking it off the exchange, removing counterparty risk, and that's something that I think is really worth talking about. And again, talking about the same thing we said about silver, the LBMA says they trade 17 million ounces of gold, but they admit that it is in the London Liquidity Survey, they admit that it's 10 times the daily net settled clearing volume, which would mean they're trading 170 million ounces of gold per day. It is this type of rehypothecation, this type of shenanigans that is making the rest of the world say, no, 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 I'll stand for delivery. Thank you very much. And whether it be gold or silver, this is a trend that is accelerating. And I say this, yes, as the owner of a large gold company, but more as someone who's trying to be completely straight with the public. There is no better investment I've ever seen in 34 and a half years of finance than silver, period. And gold is right there, but the leverage that you get and an asset that is still trading, almost half of its all-time peak from 1980 is something that has been skewed, its real value, skewed by the London Metals Exchange and the COMEX and the bullion bankers who suppress the price. Someday people will look back, like you said, and say, my God, why didn't I trust my gut on that? I don't know that I've ever seen a better value.
In a recent interview, Andy highlights the Federal Reserve's new capital requirements, which mandate that large banks maintain at least a 4.5% reserve of high-quality assets, such as Tier 1 capital. This move is strategically aimed at reinforcing the stability of the US dollar, particularly as the growing influence of BRICS nations poses a challenge to its dominance. The shift from the previous 0% reserve requirement, which had been in place since the pandemic, reveals the precarious nature of the banking system that had operated with minimal safeguards. Andy notes that banks may respond to these new regulations by increasing their holdings of unencumbered physical gold, which Basel III now recognizes as a high-quality liquid asset equivalent to cash. This change boosts gold's status and forces a broader reconsideration of what constitutes financial security. In an era where fiat currencies are under increasing scrutiny, the IMF's recent emphasis on the need for central bank digital currencies, CBDCs, to be backed by tangible assets further underscores this shift. As banks work to comply with these higher standards, they may trigger significant market shifts. The potential need for portfolio restructuring or asset liquidation could increase demand for safer assets like gold and other high-quality reserves. This adjustment could have a ripple effect, reshaping market dynamics and reinforcing the role of tangible assets in maintaining financial stability.
Crazy that is. At only 4.5% reserve requirement is what is needed. So, that means they have $4.50 for every $100 that they have to keep that on hand. So what if, $10 worth of deposits want redemption? That means they have to sell assets. It's a step in the right direction, of course, but it just goes to show how far, these banks are from being sound. If 4.5% is the requirement. Certainly, it does shine a light on the validity of gold, and maybe indeed we will see some of the Western commercial banks start loading up on gold. It takes out of the equation the ability to have paper gold as listed as gold on your balance sheet. So it has to be unencumbered physical gold, beneficial. And look, the IMF, which is, the Western friendly institution, we've talked about this on your show a lot. Kristalina Georgieva said a CBDC that's not pegged to something is fiat. And if you were to Google gold as an international reserve currency, and highlight that word, international reserve currency, a barbarous relic no more, ? You would see a report that was authored by the IMF at the beginning of 2023. They understand what gold represents, and this is a transition towards the Basel III initiative where gold is being recognized as a high quality liquid asset, in essence, as good as the dollar, as good as cash, or really as good as gold. But I think you have to do that because the banks are massively over leveraged and undercapitalized. For the past several years, they've been required to maintain a 0% reserve requirement. So that's a step in the right direction. Just this week, by the way, as a side note, that was talking about some trouble that TD Bank had found themselves in after it appears that they've been taking laundered drug money or something along those lines. And basically the author said that he was told in confidence that it's going to move to the United States, where one of the big commercial banks is going to be in trouble, and more or less intimated it was Bank of America. Now I don't know that to be true, but you look at a bank like Bank of America. Not only are they holding 1 billion ounces of silver short, but about 35 to 40 million ounces of gold short in paper. What does it do to a bank like that, who is, again, wickedly leveraged, wickedly undercapitalized? And if something were to happen to this bank and all of the derivatives, even in precious metals, what would that do to the whole system? The systemic nature of all of these banks, the incestuous systemic nature, where they're all tied together like in a web, is very, very concerning. So that's why they're doing this. But are they going to sacrifice one of the big boys at the altar? Don't know. I think they will. And if they did, it would, in my mind, be Bank of America first on the chopping block.
According to UBS, silver price forecasts have been revised upwards due to strong industrial demand and potential supply issues. Silver is projected to reach $34 per ounce by the end of September, with predictions of $36 per ounce by the end of 2024 and through March 2025. A further increase to $38 per ounce is anticipated by June 2025. This adjustment reflects a 9% rise in industrial demand, driven particularly by a 20% increase in photovoltaic sector needs. How will rising demand and supply constraints shape silver's market in the coming years? Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.